Welcome to the Harneys Investment Funds podcast series. Today we are looking at the next phase of PRC inbound investment, not just how international and regional investors access China, but what products they use, how Hong Kong Connect schemes are evolving, and how regulators are balancing innovation with investor protection. I'm delighted to be joined today by Claire Chan, Executive Director and Head of Legal and Compliance of China AMC in Hong Kong, to discuss new trends regarding ETF Connect, northbound MRF, WMC, the renewed interest in 60/40 ETF strategies. Thank you very much, Claire, to be with us today. To start, how would you characterize global investors' appetite for PRC exposure today compared with 12 or 24 months ago? And when investors look at China now, what are the main entry channels they are using?
Thank you for having me here, Stefan, and thank you, Harneys. In my view, and to answer your question, 12 to 24 months ago, global investors were more cautious about PRC exposure due to worrying about the post-COVID economy recovery. But as China A shares rocketed in late 2024 and throughout the 2025, we are all quite optimistic right now. And to me, the mainstream approach has slowly moved away from broad generic market exposure toward targeted tactical allocation designed to capture specific policy tailwinds and also local investors' aptitudes, like the high-tech company, AI companies, and also RMB denominated bonds and also high dividend products. This is why we see a number of the newly set up products with this exposure being offered in Hong Kong the past few months. And to me, Hong Kong remains stable and strong as an international center to bridge the capital flows between global and mainland China, primarily through a few entry channels specifically set up in Hong Kong, like the QVRQV in early days, and then following by Stock Connect, Bond Connect, CIBM SX for institutional investors. And the new latest channels will be the ETF Connect, MRF, and also WMC for Greater China Bay, both for institutional and retail investor to access and invest in mainland China, and vice versa for mainland China to enjoy the assets overseas.
Yes, and thank you, Claire. There's a lot of these access channels you mentioned: QFR, QFI, Stock Connect, Bond Connect, CIBM Access, and new ones that are coming in, and ETF Connect being one that we are going to spend time on later on in this podcast. But how are the roles of these various access channels evolving over time? Are some of them sort of taking over from older versions of access channels?
Yes, definitely. I see the ETF Connect is a very hot topic right now. It's still the spotlight of the WMRF and also WMC, and also QVRQV. They may be slowly, moving away out of the pictures. So ETF Connect is very hot, as I just mentioned, because the cross-border ETF turnover is exploding. The average daily trading volume for the ETF traded through the Connect, we saw a massive year-over-year increases. By April 2026, ETF Connect AUM reached 680 billions Hong Kong dollars, with an average monthly trading volume of the 40.8 billion Hong Kong dollars. And the reasons behind its popularity are, I think, one is conventional advantages of the ETF, which are all we know, low cost, transparent, highly liquid investment tools, right? And the second of all is the effectiveness of the channel for investors to sufficiently and effectively gain the handful of the exposure to China, or vice versa for Chinese investors to access to the unique global themes or hot sectors internationally through an all-in-one product.
So obviously, ETF Connect has become a key part of this access architecture. Has this ETF Connect changed in practice how issuers like China AMC or investors are, designing products? And is ETF Connect now becoming really a product highway and not only an access channel?
ETF Connect's program is doing really well nowadays. It have just been has having its largest expansion in January this year. A lot of new ETFs have been added to both the northbound and southbound ETF program. Because this program has already have enough broad-based ETF, issuer like us is slowly focusing to thematic ETFs like the high dividend yield biotech theme, high tech theme. And I see more tech centric ETFs may come into the market sooner and later, like an AI specific ETF and Halos specific ETF. Halos mean high assets, low obsolescence, and also even quantum computing and robots ETF may come to the market to enjoy the ETF Connect program. And the major advantage of ETF Connect is because there's no additional approval layer in mainland China or in Hong Kong. So the investor in either jurisdiction can enjoy the products once it gains 6 months of track record and it gains a scalable size in its primary domiciliation. And this program only has daily trading quota, not an AUM aggregate quota on a product level like the MRF or WMC regime. So it's definitely, I agree with you, Stefan, it's a product highway.
Let's look into the 60-40 rule. So, it started as a requirement to have a pretty significant allocation to Hong Kong listed stocks that started around 90 or 80%, now down to 60% with 40% allocation to the overseas market. So, how do you integrate that rule and that sort of ratio in designing products that you will then put on the market?
The percentage coming down is actually really loved by the markets because 60 it means at least 60% of the ETF's underlying index rates must consist of Hong Kong listed stocks. And the other 40% means investment visibility in global assets, like in US, Japanese, or European securities, or specific international sector like a theme, tech theme or biotech theme, like aforementioned. So the percentage of that 40, the more the merrier. And this structure creates a compliant bridge ETF that qualify for the ETF Connect program, offering more external or foreign exposure to the mainland investor. Is also meets the local investors' aptitude. The only downside I could think of ETF Connect right now is because of its eligible product universe remains to be quite limited. It does not include commodities ETFs, bond ETFs, and leverage inverse products. And I would love to see that if the 40% visibility being widened to include the indirect investment like the fund of funds, derivatives with underlying links to the equities, and also direct investment in commodities and bonds. I believe that regulators are having this suggestion in mind already and are thinking about it.
Thank you. Just looking at Northbound MRF, Wealth Management Connect, how do they fit alongside the ETF Connect? And are they competing channels or are they more complementary?
They are more complementary because these three channels they are serving different types of investors. First of all, MRF they are serving a wider mainland China public as well as they are loved by the China institution
Mm.
investors. Wealth Management Connect, they only allowing investors in the Greater China Bay, like the Guangzhou area, to participate in. And ETF is for retails. And all the retails in mainland China, they're loving the ETF more and more nowadays. And we see from data, they're participating in the ETF Connect program is actually increasing every day and is spoken by the daily trading volume.
Mhm.
And the other complementary point is that MRF and WMC they only include unlisted fund, but
Right.
ETF is about listed fund. Regimes they are supplementing each other.
Okay, fantastic. So, across these products, do you think that regulators are now becoming more open to innovation?
Yes, they are. Definitely. Regulatory dynamics have been increasingly diversified and accelerating nowadays. And regulators, they're losing the marketing constraint and which provide a greater commercial space. And at the same time, it simultaneously establish higher compliance requirement and stricter risk defenses in substance. Hong Kong position is getting clearer to achieve an Asian version of the Luxembourg, which means a product manufacturing hub in Asia or even globally if I'm not too ambitious. But it is not only just a product manufacturing hub, it is an innovation laboratory for the mainland China to compete with the rest of the global financial markets.
Fantastic. Well, final question, Claire. If we speak again in a year, what development in PRC inbound investment products do you think we will be talking about most?
We will talk about the broader scope of the eligible products and like the active ETF because mainland China regulator has only been opening up to active ETF locally. And I think we will also talk about derivatives ETF, such as the single stock LI products which have just been introduced by Hong Kong regulators 2 weeks ago. On the other hand, I don't think tokenization and digital assets will be soon accepted by Chinese government for local Chinese to invest because they only been issuing RWA circular in February this year, strictly prohibiting the digital assets and tokenization innovation within mainland.
Thank you, thank you. And obviously we've not spoken much about fund vehicles and fund formation, but I think it's also important to remind that whether Cayman, Hong Kong, Luxembourg domiciles are, it's key for them to be compatible with all these China access channels and remain connected to those various connecting programs and schemes. So thank you very much, Claire. That was a very useful tour of where China access is heading, from traditional inbound channels to ETF Connect, which now is taking the spotlight, and cross-boundary wealth regime, to more sophisticated product debate around allocation, leverage, inverse exposure, and investors protection. Thank you very much, and let's
You.
stay tuned for our next edition of our investment fund podcast series. Thank you, Claire.
Thank you, Stefan. Thank you, Harneys.